Well, good morning, Jagender Rana here. The topic for our discussion today is what is contribution in insurance? Contribution and insurance. Where there is more than one policy in force at the time of loss, then the contribution arises. So, contribution is the second corollary of the principle of indemnity. After subrogation, means contribution is the right of an insurer to call upon others similarly but not necessarily equally liable to the same insured to share the cost of an indemnity payment. So the crucial point is that if an insurer has paid a full indemnity, that insurer can recoup an equitable proportion from the other insurer of the risk. If a full indemnity has not been paid, then the insured will wish to claim from the insurer also to receive an indemnity. So the principle of contribution enables the total claim to be shared in a fair way. So how contribution arises? There are requirements of common law before contribution will arise. The following conditions need to be met. 2 or more policies of indemnity must exist. The policies must cover common interest. The policies must cover a common peril which gives rise to the loss. The policies must cover a common subject matter, and each policy must be liable for loss. There is no question of policies needing to be identical in terms of covering the same interest or perils or subject matter. The point which is important is that there is an overlap between one policy and another. It was firmly established that contribution would only apply when there was same or common interest in the subject matter of insurance. So the perils insured by each policy need not be identical under each contract. All that is required is that the common peril which causes the loss is covered by both policies. So there is some form of property as a common subject matter, but need not necessarily be so. It could be concerned with dishonesty or legal liability rather than tangible property. So when contribution operates, contribution can operate under different circumstances as discussed in the various situations. Common law says when an insured has more than one insurer, he may confine his claim to one of them if he wishes to do so. In that event, the insurer must meet the loss to the limit of his liability, and that common law can only call for contribution from the other insurers after he has paid. So this continues to be a position in marine policies. However, in most of marine policies, there is a contribution condition, and this is a contractual condition. Insurers word their contribution condition to state that they are only liable for their rateable proportion of the loss. This means that the insurer is liable for their share only, and it is up to the insured to make a claim against the other insurer if he wishes to be fully indemnified. The condition does not require the insured to claim from the other policies, although clearly in the case it is in his interest to do so. The purpose of the contribution condition is to prevent the insured claiming from one insurer only, and then that insurer having to provide a total indemnity until such time as contribution recoveries are made. So there is a rateable proportion. There are two ways of interpreting the term rateable proportion. The first method, and perhaps more straightforward, is to say that each insurer should pay in proportion to the sum insured on the policies. This can easily be seen as For example, policy A sum insured is 1 lakh, B sum insured is 2 lakh, and C sum insured is 3 lakh, which total sum insured is 6 lakhs. In case the loss amount is rupees 60,000, which works out to 10% of the total sum insured. So the share of loss for the three insurers will be rupees 10,000 for insurer A, 20,000 for insurer B, and 30,000 for insurer C. So the shares of loss of the individual insurer is thus seen to be 10% of their respective policy sum insured. However, this method has its distinct drawbacks, and it is the fact that different terms may apply to particular policies. Perhaps there are restrictions under one policy rather than another, or is different method of assessing the way in which a claim should be settled. So the application of average condition in one or more policies arising out of under insurance would complicate the position. So though the precise way in which a claim should be shared be identified, rather than merely looking at the mathematical calculation and ignoring the policy term, however, the method of calculation is generally regarded as a fair method in this regard. The vast majority of contribution calculation arise in situations involving property insurance and especially fire insurance. So market practice has tended toward the standardization method of calculation, and some of these could be incorporated into formal agreements. The amongst large group of companies or as a market agreement for the benefit of the insurers. Property policies, in the case of property policies which are not subject to average and in which the subject matter of insurance is identical, so the loss is settled in proportion to the sums insured as is shown in the example above, where non-average policies are in contribution but they are not concurrent. In other words, the property covered is not identical. Sums insured are still used as the basis, and the calculation are often done by a more complicated method. So there is other property policies. So in the case of policies which are subject to average or where an individual loss limits applies within a sum insured, even when such policies are non-average, the independent liability method is used to calculate the proportions. Independent liability for a particular insurer may be defined as the amounts he would have to pay if he were the only insurer covering the loss. It operates as property insured with A, B for 2 lakh and rupees 1 lakh respectively, subject to the pro rata coverage average. So the value of the property is at the time of loss was 4,50,000 and the loss under consideration is 45,000. So there are 3 steps in process. Step 1, A is sum insured upon total value at risk into loss upon 1. So that will show 20,000. Similarly, B is independent liability, 1 lakh upon 4 lakh 50,000 into 5,000 upon 1, that will show 10,000 only. So the sum of the insurer's independent liabilities is less than or equal to the loss. Each insurer pays independent liability. So it is possible for more than one liability policy to be covering the same loss. This is not a common situation, however, the principle of sharing is identical and would be on the basis of the independent liability. So there are some situations in which the principle of contribution is modified, like non-contribution clauses. Certain policies have what is known as a contribution clause. A typical wording would be, this policy shall not apply in respect of a claim where the insured is entitled to indemnify under any other insurance. So sometimes market agreements are also there for this contribution. More specific clauses are there, like certain policies include a clause which restricts cover in the situation where a more specific insurance has been arranged. The most common example is a household policy which will restrict cover in this way. So this is because many individual insurers insures jewelry and other expensive items, particularly specifically say under an all-risk policy, and it is not the intention for the two policies to contribute. So this would prevent disputes and mean that injured parties are compensated with legal arrangements. Thank you. Thank you.